So what is a balance sheet? Well, let's talk about why some corporations are required to have it and others aren't, and also what is reported on a balance sheet and why it's useful for the government and also outside investors to look at. So a balance sheet is a financial statement. Along with the three big financial statements, the balance sheet provides basis for computing rates of return for investors and evaluating a company's capital structure. And there's also an income statement, which is another financial statement, which focuses on revenue, expenses, gains and losses during periods, and is also known as the P&L or profit and loss statement. And there's also the statement of cash flows, which is exactly that, the inflow of cash and the outflow of cash within a company. These are all interwoven, and some parts of each of these will be reported on the other. And I do plan on making a video for each, the income statement and statement of cash flows, to get a deeper dive on both of those. But let's move on with the balance sheet. What businesses require balance sheets? For federal income tax purposes, only C corporations are required to complete a balance sheet for their annual tax return. A C corporation is a corporation with over 100 shareholders, so almost every public company is a C corporation. Less than that would be an S corporation with 100. And this balance sheet compares items with beginning of the year to the end, so the IRS checks the balance sheet to see where money is allocated and if it matches the books and records of the company. And small corporations and companies with less than $250,000 in total assets are not required to complete the balance sheet, but will oftentimes use one to attract investors, show their ratios, and get more money flowing to the business to grow it. So before we take a further look at what exactly is reported on a balance sheet, when we're going over financial statements, there are some terms on there. So when we talk about capital, that's assets that can be used to generate profit. In more simple terms, cash or loans used to make more product, provide better services, or fund research. So you'll either take out a loan to get cash or use cash that you already have to make your business grow, make it better, more efficient, all of the above. And capital structure allocation, which you oftentimes hear, is the way a company decides to distribute the financial resources to, gain efficiency, increase profits, or enhance the overall financial outlook. In more simple terms, how a company decides to use their capital to grow or make more money. So when we look at the balance sheet, we can think of it as a business assets, liabilities, and owner's equity, stockholders' equity, as of a given date. And they are normally prepared for large companies every quarter and sometimes annually. And the classic accounting equation of assets equals liabilities plus stockholders' equity is exactly what is shown on the balance sheet. So here's a quick example of what one could look like. Shows assets with current assets, fixed assets, or also non-current assets. And the total of those should equal the liabilities and stockholders' equity, which is current liabilities, long-term or non-current liabilities, and stockholders' equity. And for nonprofit companies, it'd be net assets instead of stockholders' equity. But let's dig a little deeper into total assets and what's actually reported. So this is from Apple's 2022, 2021, and 2020 on the far right of this balance sheet, and this is their reportings of their assets. So if we take a look at what an asset actually is, it is something that provides a current, future, or potential economic benefit for an individual or other entity. So this will be something that will, generate you cash and essentially why the business runs. So if you look at current assets, here are some things listed. Cash is included in short-term investments, and current assets are something that you will look to, be able to make money off of within a year. We'll get more into this a little later, but non-current assets are things that, will take years to either return money or, before they're no longer useful. and both of those together make the total assets. So if we take a little deeper dive into current assets, so I said within a year, you look for these assets to make money. It's also known as liquid assets, or you'll hear the term liquidity, which is the ability to turn assets into cash in a reasonable time and for a reasonable price. And cash is also included in current assets. But so it's if you buy an inventory, so within, a year's time, you're looking to turn that into cash. So a current asset is something that you plan to be able to get rid of from a company perspective for cash. And so that's why they're called current assets. And this will be important when you look at balance sheets to decide how liquid a company is. If it has tons of current assets versus long-term assets, it should be able to get cash relatively quickly for all the money that is invested. So if it's not a current asset, it will be a non-current asset. So something you can't get or expect to get money off of within a year, be a non-current asset. So looking at liabilities is similar, because normally it's on the other side. So if you sell inventory, you'll get accounts receivable, which is an asset. But if you buy inventory on credit, that will be an account payable. So if we look at current liabilities and also non-current liabilities, they will add up, and these will be used for ratios. And so you can take a look at how much current liabilities and non-current liabilities a company has, and also stockholders equity down here, which will be stock, how much stock is out there, and dividends and other things associated with stock. And retained earnings is also how much profit a company invests back into the company. But both of these together, stockholders equity and liabilities, make up one part of the accounting equation. So we can think of liabilities, especially current liabilities, as any debt owed to others or money that you're legally required to repay under agreed terms. And so we think of this as we receive cash from the inventory we just sold, but we bought that inventory on credit. So whatever the agreed term is, we'll have to pay back either a percentage of that or the whole thing off by, let's say 6 months. So that would be accounts payable, and we'd put money towards that every month. This would likely be to a company or a bank, depending if we had a short-term loan or, just bought inventory on credit. And so when we look at the last part of this equation, stockholders' equity, it is the remaining assets available to shareholders after all liabilities are paid. So you can think of if a company has $300 million in assets and $100 million in liabilities, there would be 200 left of that million. That would be stockholders' equity. So that would be common stock, which is property of the shareholder, and then also any dividends that could be paid out or retained earnings that could be paid out but are instead reinvested. You can also think of it as stockholders' equity equals assets minus liabilities, which is also completing the accounting equation, but just in a different way. So if you look at balance sheet ratios, which is essentially what outside investors use, investment banks, in any financial institution that would give money to a company to help them grow, you'd look at various forms of ratios. I might make a separate video going through important ratios, but current ratio, quick ratio, cash ratio are all important. Going to the next, and I did get these off of accountingguide.com. I will put all the links to everything I used. I used Investopedia a lot to get some of my resources to share. It is a great website to learn. Accounting Guide was also great with this table, and I'll put everything in the description. But also looking at the rest of this table, debt to equity, debt to asset ratio are very often used. And the other ones are how often, inventory is sold, which is very industry based and only depends when you look at one industry compared to one another company in the same industry. So industries do matter, and you can think of it as Chevy versus Ford. You'd look at one balance sheet versus the other, and they should be similar in a ton of ways, but you can't look at Chevy versus Microsoft because they hold capital way different and use funds way differently. So you can expect Microsoft to have a lot less physical inventory and a lot more money paying programmers to make something that isn't realized yet, such as Microsoft versus Google. So a lot of these ratios and how you compare companies based off a balance sheet does matter. And I hope this video helped you better understand what a balance sheet is. Please leave a comment on anything else you'd like to see. And thanks for watching.